In today's weekly update, I just wanted to talk about the year in review and what could push prices or stock prices, around in 2019. So if we look at the year just past, the All Ordinaries, the 500 largest Aussie stocks, it wasn't the best year. So a lot of people are talking about Santa's giving us coal this year. There's no more Santa rally into December. We're down 8% this year, close to 13% from our high. And there was two big events in 2018 that were pushing us around a little bit. The first was US interest rates, and the second was the US-China trade tensions. US interest rates, they kept continuing going up for the first half of the year. So first, why are US interest rates or high US interest rates bad for stocks? First, it's because when US interest rates increase, analysts increase their expectations for US interest rates, and this increased their discount rate assumptions that they apply to stocks in their Excel models. And because these discount rate assumptions are higher, the end value that these stocks are, what they think the stocks are worth, is going to be lower. The second reason why high US interest rates is bad for stocks is because higher US interest rates usually means higher bond yields. So higher bond yields, this is usually the return that you'll get on a bond if you hold it to maturity. And with those higher bond yields, this is seen as this is essentially seen as the risk-free rate on any government bond. And because you're taking risk by going into stocks, investors want an excess return from that bond yield. So once interest rates go up and they push bond yields up, then stock potential or the risk premium on stocks has to rise. And the quickest and easiest way for that to happen is for stocks to drop. And that's exactly what they had done, or that's exactly what they did. In February, we had US interest rates rise, pushing US bond yields up, which caused a tumble in our All Ordinaries price here in February. Also pushing stocks around this year was the US-China trade situation. So with tariffs on various goods and global trade receding, a lot of analysts think that growth expectations are going to be a lot lower heading into 2019. So again, they've not only changed their discount rate assumptions, they've changed their growth rate assumptions for many corporates and their profits. That's also having a negative effect on stock prices, because if they're earning less and they're being discounted at a higher rate, then obviously the price that you're willing to pay for that stock is going to be a whole lot less. So these two things came together in October to really push prices down. So in October, we had names that dropped 25% or more, including Nine Entertainment, TechWise, MedLab, Afterpay, Domain Holdings. So a lot of these stocks did drop because of earnings or a particular announcement justified their drop. But some of these stocks dropped unjustifiably. And this is where the opportunity for you lies in 2019. But first, I wanted to talk about what I think could push prices around in 2019. So I think it's going to be the potential breakup of the EU. So we have the UK on their way out. They've got less than 100 days to get out of the EU. Parliament hasn't agreed on an exit plan yet. I even read that they have around 3,500 troops at the ready if protests do break out. Speaking of protests, you have the ongoing yellow vest protests over in France. Started over a gas tax. It was the tax that broke the camel's back. The French are one of the most taxed civilians in the world, according to OECD. They also don't have a rising standard of living to compensate for those taxes. Their wages are low, their culture is being diluted. And basically, they don't want the Macron government to continue the way they're going. They might elect a new party in who might be anti-EU potentially. Then you also have a place like Italy, who has the second highest amount of debt to GDP, I'm pretty sure, compared to Greece in the EU. They want to keep spending their money. One of the policies of the anti-EU party wants to give handouts to the poorest they want to give handouts to the poorest in southern Italy. Of course, they have to send these budget plans to the EU, and the EU, of course, knocked it back. They don't want Italy to keep spending money that they don't have, potentially causing them to default on any of their bonds, which means the EU would, again, like the Greece situation, they'd have to come in and bail Italy out. But the EU pushing back the budget plans of Italy actually works into their favour, because pushing back their budget plans shows that the EU is a socialist, dictatorial type organisation, and they might give preferential treatment to one country like Germany, for example, and they won't give it to Italy. Again, this will strengthen the argument for Italy leaving the EU. So in 2019, we might see a picture like this, where the UK is going to go out, the French potentially might go out, Italy might potentially go out. And this is the situation I think that investors will focus on in 2019. It's going to be pushing stocks up and down, much like US interest rates and the US-China trade pushed stocks up and down in 2018. But while investors are focusing on this in 2019, I don't think you should be focusing on this, or it shouldn't dictate how you invest in 2019. What you should focus on instead is important things, like you should focus on the businesses that you buy, what price you're buying them for, what they do, the industry that they're in. I think in 2019, with prices lower, it actually sets you up a lot better than in 2018, when we just came off a 2-year strong bull market. 2019, we're heading into lower prices, more opportunities for you to look in beaten down industries, and potentially pick up companies that no one else is looking at, but because you're looking at individual businesses and not macro events that don't really mean anything, or don't really mean anything in the long term, then you can actually set yourself up to actually make money. Whether you didn't make it in 2018, you can set yourself up to make money in 2019, or do a lot better than everyone else will do in 2019, because you're not focusing on macro events in 2019 that mean very little for most businesses and how they're going to earn money in 2019.
Remember to like and subscribe below if you enjoyed this video and you want to see more future weekly updates.